Everyone dreams to relax in their retirement age and reap the benefits of all the hard work they have put in. But making the right choice of investment is essential so that tax will not eat into your returns. Hello and welcome. I'm Bhavna from Clear. We are India's largest tax and financial services platform for individuals. Do subscribe to support us and get a clear explanation of all finance concepts. In this video, I will show you how to receive tax-free retirement funds. So let's get started. So first, let's look at how you need to choose the right financial product. Before investing in a financial product, you need to know about its safety, liquidity, and the returns you will earn from it. And also, you need to understand how returns earned out of it will be taxed. In some of the tax-saving financial products such as NSE, Senior Citizen Savings Scheme, 5-year time deposits with banks and post offices, the interest income earned from them is taxable each year till the end of the tenure. Evaluate what is the return you will earn after tax deduction on the financial product. So, for someone who pays 30% tax, the post-tax return on a 5-year bank fixed deposit of 7% becomes 4.9% per annum, excluding the surcharge. Now, let's look at where to invest. Making the right choice is essential to get tax-free retirement funds. With higher pensions and bigger annuity packages, post-retirement income can now easily cross the 3 lakh income tax exemption limit for senior citizens and the 5 lakh exemption limit for super senior citizens. To minimize tax, invest in products wherein either the yearly outflow or the maturity amount is tax-free. Let us discuss a few products where you can save tax. Number 1. Public Provident Fund is among the few options exempt from tax at both investment and maturity stages under Section 80C and Section 10 of the Income Tax Act respectively. One can invest up to 1,50,000 every year in PPF. It has a lock-in period of 15 years. PPF investments also qualify for deduction under Section 80C of the Income Tax Act. This reduces the overall tax burden. At present, PPF is offering 7.1% annual interest, which is linked to 10-year government bond yield and is revised every year. Number 2. Bank and post office monthly income schemes are similar to bank fixed deposits but with monthly interest payments. It is one of the most reliable sources of income for the retired. The interest rate is the same as that on bank fixed deposits. However, the interest earned is taxed, substantially reducing the post-tax return of people in the higher tax brackets. Monthly income schemes are therefore ideal for people whose taxable income is either less than Rs 3 lakh, which is the threshold for senior citizens, or who fall in the 5% tax bracket. Further, tax is deducted at source if your annual interest is more than Rs 40,000. If you are a senior citizen, the limit is Rs 50,000. Number 3. Senior Citizen Savings Scheme. Individuals older than 60 years or those who are above 55 years but less than 60 years and have retired under a voluntary retirement scheme can invest in this scheme. A person can open more than one SCSS account, but the total investment cannot exceed 15 lakh. The tenure of the scheme is 5 years, which is extendable for 3 years. At present, the scheme is offering an annual interest of 7.4%. Interest is paid quarterly and is clubbed with income for taxation. Further, tax is deducted at source if your annual interest is more than 40,000. If you're a senior citizen, the limit is Rs 50,000. If your total annual income is less than the income tax threshold of 3 lakh, you can avoid paying tax by submitting Form 15G or Form 15H. Investment in SCSS qualifies for deduction under Section 80C. This reduces the taxable income. Number 4. Debt Mutual Fund Scheme. By shifting some of the investments from taxable fixed income instruments to low-risk debt mutual fund schemes, retired individuals may reduce the regular tax outflow as capital gain tax on debt funds are calculated at the time of redemption only. By holding the funds for 3 years or more, investors may avail the indexation benefit to minimize tax outgo further. As dividends are now taxable in the hands of the investors, it's better to avail systematic withdrawal plan to save tax. I hope by now you have understood how to create your portfolio to get better returns at the time of your retirement. If yes, then please comment yes in the comment section below. Now, let's do a quick comparison of all the investment schemes we have discussed so far. PPF gives an annual return of 7.1% and comes with exempt tax status. Monthly income schemes offered by the post office provides monthly returns and is useful for senior citizens with a total taxable income of up to 5 lakh. Senior Citizen Savings Scheme offers an annual interest of 7.4% which is paid on a quarterly basis. It qualifies for a deduction under Section 80C. Since the interest received is taxable, it is suitable for senior citizens with total taxable income below 5 lakh. The Debt Mutual Fund Scheme earns you better returns when compared to fixed deposits by banks. Capital gains tax is required to be paid on the redemption of such units. However, if redemption is after 3 years, you can take the indexation benefit to lower the tax outgo. So folks, do evaluate your tax liabilities before selecting an investment option. Try to strike a balance between tax saving, income generation and safety. I hope this video was helpful. Thank you for watching this video. Do subscribe to support us and get a clear explanation of all finance concepts. Stay tuned for more updates.